Hey folks, Ty here. In today's video we're going to be talking about the biggest investing mistakes that anybody can make. So here we go, you got to avoid these. You don't want to be making these mistakes because these can cost you a lot of money, and we don't do that. We like making money. So yeah, hit the like button, hit the subscribe button, and let's get straight into it. This is going to be a nice short video. Wait for the camera to focus. Yep, this is going to be a nice short video. Just going to go over the most common mistakes that investors make and the most costly mistakes that investors make. Starting with number one, which is panic selling. Panic selling is basically the process of everyone selling. Your stock's gone down or your crypto's gone down, whatever you're investing in, and you're like, oh damn, I need to sell. So you start dumping everything, and then guess what? It then goes up because everyone's selling, and then you've got the smart investors buying at the low, buying at the dip, because you know what, we like to buy at the dip. Okay, that's not going to work with the camera the other way around, but we like to buy at the dip, and smart investors buy at the dip. So if you start panic selling and everyone starts panic selling, and then the smart investors are buying, and then the price rises, you're going to sit there and you're going to be like, wow, I made the wrong decision. And we don't like making the wrong decisions. So yeah, panic selling is a definite no. Do not panic sell. Just ride the wave. If it dips and you can't buy the dip, fair enough, just hold through the dip. If it dips more and you still can't buy the dip, fair enough, just hold through the dip, because long-term investing, dollar cost averaging, if you can buy the dip by all means. Please buy the dip. Don't be afraid to buy when it's low, and when it goes even lower, don't be afraid to buy more. Just don't panic sell, because you will be worse off. Moving on to number two. Number two is what I like to call meme investing. Now, meme investing is similar to basically everyone's doing this, so I'm going to do it too. For example, GameStop, AMC, everyone was piling on that, and yes, fair enough, people did make a lot of money from it. But if you don't fully understand it and you're just getting on it because YOLO, do it for the meme, do it for the Vine, do it for the TikTok, whatever it is, then you're going to suffer. You need to be knowledgeable about what you're investing in, why you're investing in it. And if you're fully aware, oh yes, I'm buying Dogecoin because it's a meme investment, I think it's going to go up, then fair enough, you do you. But as long as you know that you're investing in a meme, you're investing in basically a momentum play based on a meme stock, based on something that might not have the actual fundamentals, it might not have real world use. You are investing in it on the off chance that it gets picked up by Wall Street Bets or the meme society or whatever it is, whatever the reason is you're investing in it. Just be aware that if you are going to do meme investing, it's very risky, and a lot of people that go into it don't realize that the thing they're investing in, they're doing it on the back of nothing. There's no leg to stand on. There's no actual reason why it's being pumped so high. It's just happening, and people are jumping on that, and then you get a load of bag holders at the top who are like, yeah, I made the wrong decision. And again, we don't like making wrong decisions, so if you can avoid meme investing, by all means avoid it. Moving on to number three. Number three is not diversifying. Now, whether it's investing in stocks, crypto, gold, or wine, not diversifying is going to be very, very risky, because what you're doing is you are literally putting all your eggs in one basket. You are putting all your money in either one company or one type of investment. Now, if you're in the stock market and you're put all your money in one stock and that stock goes down, that's it, you're screwed. If you've in the stock market and you've got money in 10 stocks and 5 of them go down, then it's not the end of the world, because you've got these other 5 that, if you've diversified correctly, probably have balanced it out. Now, if you want to diversify even further, you would then look to invest in other markets. An example of this would be to start investing in crypto. If you've got investments and crypto, then if one goes down, the other one might balance it out. If they both go down, you're having a really bad day. If they both go up, then you're having a really good day. Now, when they both go down, you might want to add a different investment. So for example, you might want to add gold. Then when these go down, this might go up, and vice versa. You are hedging your bets and you are diversifying, and therefore you are mitigating the risk. you are lowering your overall risk because your eggs are no longer in one basket, they're in dozens of baskets. And you can do this in such a way where you're so diversified, then by using, for example, funds or different types of investments, that yes, you do have risky investments such as crypto in your portfolio, but the overall risk of your investments are low because you've diversified correctly. Now, I do go over diversification and how to diversify in my short little investment course, which I'll link up there. Shameless plug, I know, sorry. But yes, diversifying is crucial to any investment strategy, and if you don't diversify, you will suffer. Moving on to number 4. Number 4 is the mistake of trying to time the market. Now, somebody once said, it's not about timing the market, it's about your time in the market. And that's because people who try to time the market get it horribly wrong. Yes, some people do get it like horribly right and hit the moon, and then people are just like, oh yeah, I'm gonna do that, I'm gonna do this, I'm gonna make sure I buy and sell at the right price. But 9 out of 10 times you're going to get it wrong. You just are, because the market can be that unpredictable, and people are trying to do it with crypto now, like buy at the exact right time, sell at the exact right time, which is even more ludicrous because crypto is more volatile than stock market, because crypto has no open and close time during the day. It's open 24/7, can be traded by anyone around the world. And so yes, it is definitely more volatile, and it's more likely to burn the people who are trying to time the market. So yeah, do not time the market, it will work out badly. So just, it's all about your time in the market. So go in with the aspect or with the thought process of investing for the long term. And if you make short-term gains, that's absolutely great. Capitalize off that, take it out, and just accept that as a win. Number 5, the 5th biggest mistake in investing is watching your portfolio constantly. Now, this is coming from a perspective of long-term investing and buy and hold, not necessarily day trading, because if you are day trading, you are going to want to be looking at your portfolio like constantly, obviously. But from my perspective as a long-term investor who tends to do buy and hold strategies and longer term strategies, there is no need to check your investments every day, and it's bad for your mental well-being. It's not a good mindset to be in, because if you're checking daily and it's not the result that you're wanting, then it can get very deep real quickly, and that's obviously not what you want. So don't get hung up on checking your app daily. Don't feel like you need to be checking it like every hour, every day. Just, if you're into the long-term strategies, just set and forget. Fair enough, check it every now and then. Check it when you're thinking about it, but don't go out of your way to like constantly check it, because it's not a healthy mindset to be in. So that's the last thing. To be completely honest, it is something that I have found myself doing a few times, and I have to break the habit of not checking it. I'll be in the middle of conversation and I'll just randomly like pull out my phone, check and see if I'm rich yet, and it's just not a good mindset to be in. So don't fall into that trap. Just check it every now and then. Check it as and when you feel like you need to. Don't feel the need to check it every day, because in all honesty, it's not going to move that much. If you keep up to date with news and catalyst events, if something's happened, then by all means check it, but don't get hung up on it. Don't let it affect your day-to-day well-being or anything like that. So that's all from me. That's the 5 biggest investment mistakes that I come across. You've got panic selling, you've got mean investing, you've got not diversifying enough, which is a big one, trying to time the market, and of course constantly watching your portfolio like a hawk. It's not good. Don't fall into any of these traps. Don't do it, and you will increase your chances of success when it comes to investing. So thanks ever so much for watching. If you've got any questions whatsoever, then do hit them down below. I post every week without fail, investing, crypto, metaverse, dropshipping, all that good stuff. So if that's what you're interested in, do check out my channel and my other videos. Thanks again for watching, and I'll see you in the next one.